Hi, I'm Heather Myers, Managing Director for Russell's nonprofit team. There are a number of return opportunities in today's market. The challenge is finding them and then putting them to work before they disappear. To capitalize on these opportunities, it is important to have a clear vision of your investment goals, a good way to assess how each opportunity fits, and a decision-making structure that enables you to manage your portfolio dynamically. Russell has developed a 3-step process to help you do just that. Step 1, manage your investments at the total portfolio level and make sure your reporting reflects this. It is important to focus on the true purpose a specific investment strategy plays in your portfolio. For example, is the role of your fixed income assets to provide risk reduction or enhance returns? Understanding how these assets are performing against their asset role within the broader portfolio is often more important than how a specific asset class has done against its assigned benchmark. Additionally, your portfolio reports should provide you with insight into how the portfolio is behaving relative to policy and different market environments, instead of only providing benchmark relative performance. The reports are a tool to help you determine if the portfolio is positioned appropriately for future expected and unexpected scenarios. In other words, they should show you the liquidity of your portfolio in times of crisis, your ability to meet your spending targets during good, neutral, and poor markets, and where the major risks exist in your portfolio. Step 2, manage risk at the total portfolio level. It is likely that each member of your investment committee has a different level of comfort with risk. As a team, you need to set and stick to a risk budget, and then within that budget, only take those risks where you feel you will be rewarded. Let's say you're comfortable taking on illiquidity risk. That opens up opportunities for you to explore more options and alternatives. If you're not comfortable with illiquid assets because of your spending needs or some other constraints, you may have to consider other instruments that can give you a higher level of return. With that will likely come the trade-off of more risk. Step 3, modify your governance documents to reflect your willingness to be dynamic. Your investment policy statement, your spending policy, and your asset allocation policy documents should all be aligned to reflect your desire to manage your portfolio dynamically. By this I mean, do not approach portfolio management with a set it and forget it mindset. Take the time to really define what you mean when you say dynamic, and then capture the definition in your documents. It is critical new investment committee members fully understand the goals you are trying to achieve, the amount of discretion you have decided to delegate to your service providers, and where and under what circumstances you have chosen to be dynamic. You can lose valuable time educating a new team member and miss opportunities in the markets. These documents also keep your goals front and center and ensure you are constantly making decisions that will ultimately help you meet your spending targets. Your investment program is a means to an end. Your ultimate goal is to allow your portfolio to grow in perpetuity while meeting the current spending needs. Keeping this at the forefront of your decisions will help you best tackle the challenges ahead. I'd love to talk with you to see how we can help. Thank you.